let's take a look here and go through some of the mechanics here. So, topic here, maximize cash value and flexibility, right? When we think insurance policy or insurance product, regardless if it's life insurance, auto insurance, whatever it might be, typically we have a premium where we pay that premium and we have a benefit. We don't have much flexibility as far as adding more money into premium, adjusting it up and down. So the question is here, when we've got this cash value benefit that so many people are attracted to once they understand it, how do we design it where it's flexible, where I don't have this bill that I feel like it's a burden. I got to pay the same amount every month, every year. What if things get tight? What if I want to do something else with my money on any given year? So when we pay any amount of money into a life insurance policy, here's the thing on this. We can choose where it goes. I can direct it toward the insurance premium or what is called a PUA rider. PUA stands for paid up additions. So I want to understand the relationship of these two areas. English translation here to make this simple. The premium I'll refer to as the initial insurance expense, and the PUA rider I'll refer to as a cash dump in. And you'll see why in a second here. So let's assume that I am going to pay in $1,000 per year into the premium piece. How do those dollars work? Well, the dollars that I direct towards the premium in respect to your cash value, you will often see 0 show up in the first year and often the first and second year. If you recall that traditional policy, it was just year 1 where he paid in $100,000 and had next to nothing. 3%, $3,300 of that 100K show up in cash value. Beginning year 2, it came back to cash value for him. So point here is when we hear the word premium, we often think expense, indefinite, I'm just buying an insurance benefit, which you are with that. However, once we hit the third year, second or third year, depends on the product, you will find that money comes back to work for me. So it does begin to capitalize the policy and I have access to my money. Now, why I have nothing right off the bat is really because the insurance company is going to overcharge me for the cost of insurance or death benefit up front. So with a whole life insurance policy, when I have nothing in the early years, typically the first 2 with most companies and products, the reason why is that the insurance company is overcharging me for the death benefit, the cost of insurance. Now, I've got the PUA component. If I pay the same $1,000 per year into this area, here's what your policy will look like. If I pay $1,000 in, I'll see right off the bat, just about $1,000 show up in cash value. This is money I have access to. This is money I start to see the guaranteed rate and any surplus, or call it total dividends, applied to. Now the term, again, stands for paid up additions, paid up additional life insurance. And what that means is 1, this is optional, but when I make a payment into this component, shows up in cash value, it also purchases me some death benefit. For a 40-year-old male, like the example we just saw, on average, you may see if I pay in $1,000, $3,000 may come back to death benefit. It purchases me additional life insurance as well. However, the attractive component here is directing funds towards the PUA rider to accelerate the cash value growth. That's the area where everyone's interested. So a question we'll often get is, okay, Steve, thanks for going through that, appreciate it. However, I don't care about the death benefit, so how do I put 0% of my payment here and everything else into PUAs, regardless of how much I'm paying in? So we can't go quite that aggressive. The reason why is we have to be aware of the different limits. 2 limits. we have the insurance company limits, and then we also have the IRS limits. Let's first go through the insurance company limitations. This will differ from insurance company to insurance company. You will find with those top companies I mentioned earlier, you'll see right around, if you set the policies up properly, this 10% premium, 90% PUA. And again, I'm not going to mention any specific company there because they're all different. Some let you go a bit higher than that, some are a bit lower. That's just a general average here for the sake of this discussion. But what this means, right? So if I tell you, okay, you can have a minimum 10% premium, okay? Like what's that mean in terms of me paying money into the policy? Well, if we take this example we have right here, and you pay in $1,000 towards the premium, that means you have the ability to pay up to $10,000 per year, meaning you can add another $9,000 into the PUA component. So I'm committing to the $1,000 and have the ability to go up to $9,000, which will accelerate my cash value to a much greater degree. So the first limit, the insurance company limit, however much I want the ability to add in, the premium must be 10%. So I cannot pay in $100,000 if I have a $500 minimum premium. I do have some limitations there. The second limit has to do with the IRS. So the term here that we want to be aware of is MEC. Modified Endowment Contract is what this stands for. Now, again, a core benefit to a cash value life insurance policy is that if it's all set up properly, safe, liquid, tax-free. The tax-free component is what so many people are attracted to. If a policy becomes classified as this modified endowment contract, I have to deal with taxes. Very similar to that of a 401k, not in the sense that I can deduct payments. I cannot do that with a MEC, but more so that the money still grows tax deferred. However, when it comes to the gains, anything I access, I am liable to pay income tax on the gains, in addition to a potential 10% penalty tax that exists, that 10% penalty tax, if I am under the age of 59 and a half. So this ruins everything. The question is, how do I get rid of it? How do I make sure it does not occur so I can reap all of the benefits of a cash value life insurance policy? Quick side note, with a modified endowment contract, the death benefit is still paid out income tax free because it is still a life insurance policy. But how I prevent a MEC from occurring, which will ruin a lot of the benefits to the cash value component, is every policy has what is called a MEC limit, which is exactly what it sounds like. It is a limit that determines the maximum amount of money I can pay into a policy per year and still have the IRS consider it life insurance and not a pure taxable investment. So, how we set that limit, a lot of people aren't aware of this, this is pretty neat, is we can set that limit wherever we want, and what you'll find is it has a direct relationship to my age and death benefit. Gender plays a role as well, but primarily age and death benefit on a life insurance policy will determine how much MEC space, call it my total MEC limit, what that figure is that I have the ability to pay into a policy. This is a technical piece. We don't have to know all of this. If you say, hey, just show me a max funded policy, yeah, we can definitely do that, or we design it for a lot of agents we work with and consumers that purchase policies through us as well. But if you like the details to understand how this should work, well, this is it. So this is really critical points, critical knowledge that I want to have if I'm a consumer, right? If I'm you, knowing this, at least the bullet points here, will give me enough information to know, okay, when I see a policy, I know that I can add more money in here, and if my goal is cash accumulation, well, I want to do that because this will give me greater cash value. So let's continue on here. So that's the cash value piece. Next, let's touch on flexibility. So if someone states, I want the ability to pay in $100,000 per year, but I don't want to get a bill for $100,000 per year. So I love the benefits of cash value life insurance. I want the ability to pay in this much, but I don't want it to feel like a burden and get this huge bill every year. Same thing if it's $1 million. So in the policy design here, we can set the premium at approximately $10,000. The MEC limit at $100,000, maybe a little bit higher. If we want to fund for a long time, we'll overinflate this. But what this allows me to do now is commit to approximately 10K. It'll fall between 10 and 12K most likely, because we have to attach what's called a term insurance rider to this policy to give me the ability to add more funds into it. But the main point here is I have a minimum commitment with the ability to add more money at leisure. Now all of a sudden, I've taken an insurance policy, which again, we think insurance, boring bill, pay the same amount, and we've shifted it into a flexible savings asset. I'm still committed to that minimum premium as long as I'm still funding it. However, I can make the excess payments at my discretion. It does depend on the company. All companies have different flexibility features. But let's look at this a little bit more to illustrate. Let's look at a visual. So on the left, you see the traditional policy we started with. That was the all base premium 100% insurance expense example. Then we see the max cash value policy. And again, same company, same product, different design, same individual health rating. Everything's consistent here, only we made some tweaks in the actual design of the product in order, call it to reverse engineer it and beef this up. So he's paying in $100,000 per year. Immediately, we see 88% of his payment show up in cash value, and he has a $4.25 million death benefit. Healthy policy in that respect. What's highlighted in yellow represents the break even. Cash on cash, call it, by year 4, I've paid in $400,000, I have $405,000. He funds it only for 10 years, and after this point in time, pays in nothing. So our annual outlay is 0. That means no premium, nothing. We shut the funding down earlier. This way, because he didn't want to pay anything else in, the cash value continues to grow with no out-of-pocket. Now, if he decides that he wants to continue to pay, you can easily design the policy to accommodate that. Now, on the design piece and flexibility, here's what we want to touch on. The premium in this example, just about 10%. That includes the minimum premium and that term rider we mentioned briefly earlier. So we can commit to approximately $10,000, just a touch higher, and then at discretion add up to $100,000. On the right, this annual IRR. IRR represents internal rate of return. And annual only represents what he is earning year over year. So what is the cash value growing by each year? And why I emphasize that is if I look by year 4, I've paid in $400,000 and have a $5,000 gain. The annual IRR represents 2.94% that year. 3% on $400,000 is much more than 5K. So that would be the average IRR if we want to look at here. Here, the annual internal rate of return just represents each year what it's producing, tops out a little over 5%. And this is based off of a current projection. So one thing, whenever we look at projections, they're all well and good, but it's very good to look at the guarantees. It's also very good to look at actual performance, historical performance, what companies with different products have actually delivered as opposed to just projecting the best numbers so we have more than a piece of paper then. So this talks about we just talked about designing a policy, how to set it up for maximum cash value, maximum flexibility. This, in my opinion, is one of the most important pieces, because if you've got this all set up, now you've got a policy that's maximized for cash value, very flexible, regardless of what I do, I've got a maximum policy here. Cash value, accumulating, a lot of options I have. Now, the next step is how do I use it? Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like,
and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.